Our next topic in the cost of capital is looking at the WACC in practice. Here you can see the WACCs for real companies. This comes from your textbook. I want you to notice that the WACC is driven by the risk of the company's line of business, and because of the tax effects of interest, it's leverage or amount of debt. So it can vary across industries and across companies. Some lines of business are riskier than others. So selling chocolates, Hershey's, should it be less risky? But selling high-end cell phones, Apple and BlackBerry saw, is a very risky business. Even selling high-end clothing like Nordstrom is risky. Now, we're going to look at some issues that arise for financial managers when they're estimating the WACC in practice. When calculating the weights, it's increasingly common to make an adjustment to the debt called net debt. Why subtract their cash from their debt? The assets on the balance sheet include any holdings of cash or risk-free securities. If they have $1 in cash and $1 of risk-free debt, then the interest earned on the cash will equal the interest paid on the debt, if it's risk-free, that is. So the cash flows cancel each other. In fact, we view cash as being equivalent to negative debt. Significant excess cash on the firm's balance sheet can complicate the assessment of risk. So practitioners often measure the leverage of a firm in terms of its net debt. So it could be important. The next thing is to determine the market risk premium. For most firms use the yield on 10-year Treasury notes or long-term Treasury bonds as the risk-free rate. From 1926 to the present, the S&P 500 produced an average return about 5.9% above the rate on a 10-year Treasury. However, since 1962, it has been an excess return of only about 3.8%. So more investors will construct a portfolio, assume that financial managers assuming the market risk premium was closer to 4% than 6%. Why the decline? Well, more investors are participating in the stock market, and the cost of constructing diversified portfolios has declined, so they're less risky, and the return for taking on that risk is diminished, and the overall volatility of the market has declined over time. And we see this here. We look at, some people do use the 1-year Treasury, but it's probably much more accurate to use the 10-year Treasury. We're looking at a longer-term investment, not a short-term investment. Now, we're making some assumptions here with our WACC. We initially assume that the market risk of the project is equivalent to the average market risk of the firm's investment. So we're going to assess the project's cost of capital based on the riskiness of the firm. In our next section of videos, we're going to look at project risk when we go into a new area of business that is not the same risk as that of the firm. But if the firm has risks in the projects in the same business, we can do that. Secondly, we know that there is some adjustment in leverage. We're going to assume that they have a target constant rate of debt to the market value of equity. And so we assume that the firm's equity and debt and the riskiness thereof, and therefore the WACC, will not fluctuate due to changes. Now, firms do tend to have a little more debt as they get more mature and can handle it, and the market's willing to supply the debt to the firm. Now, we say that the main reason why firms like to have debt is the interest deduction. We're thinking that other factors such as possible financial distress are not significant at the level of debt chosen. We know there are firms that declare bankruptcy, but we're going to ignore that in our discussion here. So for all assumptions, there are some firms for which this does not apply. Now we're going to look at an example. Starbucks is introducing a new product called Cafe Mucho. It's going to cost $280 million to bring the product to market, but they expect first year incremental free cash flows to be $80 million and to grow at 3.9% per year. Should Starbucks go ahead with the proposed project? Well, we can use the WACC method to value Cafe Mucho and then subtract the upfront cost of $280 million. We're going to need Starbucks WACC, and if we looked at figure 13.3, that is 9.9%. So the cash flows are a growing perpetuity, and I had to do a little adjustment by hand here. The value of the levered firm is the free cash flows at time 0 plus the free cash flows at time 1 using our perpetual growth model, the constant growth model. Divide that by the cash flow, the WACC minus the growth rate. And you can see we minus $280 million at time 0, 80 million divided by 0.099, 9.9% minus 0.039, the growth rate of 0.06 gives us a value of 1.053 billion, over $1 billion. So it seems that it certainly makes sense for Starbucks to do this project, that by doing so, they are getting a return substantially above the 9.9% cost of capital of the firm, way above their required return. So this is a way we can use the WACC method in practice. Now our next topic will be looking at project-based capital cost if the project is not in the same business as the rest of the firm and we need to adjust for risk.